Here's a riddle. What offers shelter from the elements, holds your memories, and builds wealth and stability? Easy! It's the house I'm gonna help you buy. I gather from the fact you're here right now that you're thinking of buying a house. First things first, congratulations! House, condo, McMansion in the burbs, whatever you're looking for. This is one of the biggest decisions, financial or otherwise, most of us will ever make. That's why it's a good idea to take it a little slow and make sure you're super duper prepared to enter the usually expensive, occasionally confusing, but always exciting housing market. Consider these next steps your cheat sheet. 13 is about to become your new lucky number. Deciding if it's the right time takes more than a pep talk in the mirror. There are two parts of being ready. The first is timing, and the second is your financial health. Getting a 30-year mortgage doesn't mean you have to stay in your house for 30 years, retire in it, and create a community bingo team called the Diagonal Divas, but it's way easier to move if you don't have a house. Think big picture about your career, goals, and family. If staying 3 or more years feels good, move on to finances. We'll cover the details in a second, but at a basic level, your income and job should be steady, and you shouldn't be drowning in debt, and you'll need some cash on hand for closing costs and furnishings. Market conditions, lifestyle preferences, and finances all play a role in timing, but the only person who knows if you're ready is you. Everyone has different philosophies, but 30% of your income before taxes and other deductions is a decent place to start. You should also look at your debt to income ratio, which is all your monthly debt divided by your gross income. So out of that $6,000, you owe $2,000 in student loans, credit cards, and other mandatory debt. That's a DTI of 33%. Most lenders deny people with a DTI higher than 50%. You should also factor in the other costs of buying and owning a home. Things like repairs, you can estimate 1% of your home's value each year for that, property taxes, which will be rolled into your mortgage payment, and private mortgage insurance, which is insurance you have to pay if you have less than a 20% down payment on a conventional loan. I'd go to an affordability calculator and start plugging in numbers. But remember, just because a calculator says you can afford something doesn't mean you should run out and buy it. You need to be able to pay for this thing in good weather and in bad. Lots of people think you need 20% to buy a house, but nope, not true. You can get a house for as little as 3% down on a conventional loan. That's $9,000 of a $300,000 house. It can be as low as 0% on VA and USDA loans. But you have to pay for that convenience with higher interest rates and additional fees depending on your loan type. You also need to cover closing costs, which are the fees that stack up when buying. Think things like appraisal fees, title insurance, and so on. These are usually 3% to 6%. So on a $300,000 home, you're looking at $9,000 to $18,000 in addition to your down payment. There are 4 major types of mortgages: conventional, FHA, VA, and USDA. Conventional loans are private loans not backed by the government, and they're the most common. Basically, if you go to a bank, this is what you're getting. You need at least 3% down and usually a 620 or higher credit score. FHA loans are designed to help people get into houses sooner and are guaranteed by the government, making them less risky for lenders. There are more restrictions for FHA loans, like the loan has to be for your primary residence, but you can get one for as little as 3.5% down. VA loans are exactly what they sound like: special loans for veterans, active service members, or qualified family members like surviving spouses. You can put as little as 0 down, and they have lower credit score requirements. For example, Rocket Mortgage has a minimum credit score requirement of 580. USDA loans help people in rural areas buy homes. You can get a USDA loan with 0% down, but your home must be in a specific place, and you must meet income eligibility rules. As of 2023, Rocket Mortgage does not offer USDA loans. Getting pre-approved means a lender has looked at your finances and given you a range of how much you can borrow. This is one step further than a pre-qualification, so if you're ready to buy, I'd get pre-approved. After deciding on a lender, they'll ask you some questions, pull your credit score, and so on. A good agent is your resident expert on everything. They're like a constant advocating angel of knowledge who guides you through everything, finds great homes, writes offers, fights for you in negotiations, everything. It's just inspiring. Not working with an agent is like deciding to go on a safari without a guide. I mean, you could, but should you? Ask family members and friends for any agents they like. If that isn't an option, check out a trusted and transparent source like the Verified Partner Agent Network from Rocket Homes. The link is in the description. Let's be honest, this is the exciting part, but with house hunting, the trick is seeing how what you want can fit into what you can afford. Start by thinking through these criteria with your agent. Price, square footage, home condition, access to public transportation, number of bedrooms and bathrooms, backyard, swimming pool, local entertainment options, local school district ranking, property value trends, property real estate taxes. Then, rank your priorities according to your budget and find recent examples to share with your agent. For example, you may say something like, our budget is $325,000, but if a house had a fourth bedroom and was in this particular neighborhood, we'd be willing to stretch to $360,000. Remember, only you can decide which property is right for you, so make sure you see plenty of homes before you decide which one to make an offer on. Making an offer means sending sellers an offer letter with a dollar amount, any contingencies, a deadline to respond, and any earnest money. Earnest money is usually 1% to 2% of the selling price and shows you mean business. If you follow through and buy the home, that money just goes towards your down payment or closing costs. But if you pull out late in the process after agreeing to buy it, the seller may be able to keep it. Your agent will write the letter, and then the seller can either accept, reject, or counter. This is also when you can negotiate any contingencies, like making any repairs revealed in an inspection, and so on. After a seller accepts the final offer, it's appraisal time. Appraisals are required by lenders, and it's when a licensed appraiser visits the home and gives their best estimate of the value of the home. Lenders require appraisals because they can't lend out more money than a home is worth. If the appraised value comes back lower than your offer, you might have trouble getting financing. You should also include an appraisal contingency with your offer. Appraisal contingencies allow buyers to back out of a purchase or negotiate a lower price without losing their earnest money deposit if the home appraises for less than the offer amount. Inspections usually aren't required, but do not skip it. That would be like buying a car without looking under the hood. Inspectors come out and look at air conditioning, electrical units, the foundation, the roof, appliances, and everything else that can be considered the bones of a home. Then they give you a report of what they find. After you review your inspection and appraisal results, you might want to ask your seller to correct some of the problems you found. You can do this in one of three ways. Ask for a discounted purchase price, considering the results. Request that the seller give you credits to cover some of your closing costs, and ask that the seller have the problems fixed before you close. Always do a final walkthrough in your new home before you close, even if you're 100% committed to the property. Check your repair areas if you requested them, and keep an eye out for pests. You may also want to double check your home systems one final time to make sure everything is in working order. Flush it. Go ahead. You know you want to. And last, but in a lot of ways, just the beginning. Your lender is required to give you your closing disclosure, which tells you what you need to pay at closing and summarizes your loan details 3 business days before the big day. Read through your closing disclosure and make sure the numbers don't vary too much from your loan estimate, which you should have received earlier in the process. After that, it's time to attend your closing meeting. Bring your ID, a copy of your closing disclosure, and proof of funds for your closing costs. You'll sign a settlement statement which lists all the costs related to the home sale and is when you pay your down payment and closing costs. This is when you'll sign the mortgage note, which states that you promise to repay the loan. Finally, you'll sign the mortgage or deed of trust to secure the mortgage note. And now, look at you! You're officially a homeowner! Woohoo! Psh, easy, right? I know it's a lot. But remember, this process takes time. It's not like this happens overnight. The average length to buy a house is 5 to 6 months. We know you got this. Happy home buying! Are you ready to learn even more about home buying and home ownership? Visit rocketmortgage.com/learn right now for even more tips. See you next time. Thanks for checking us out today. If you'd like to see more videos just like this, guess what? You can click right here. And don't forget to like and subscribe. See you next time.